Good day, everyone. I am Cedrian Federico, and we will gonna discuss about risk measure and risk reduction. And this topic is done by group, so we divided the task to our members, and each member has part to discuss of this topic. And as said a while ago, our topic is risk measure and reduction, and risk measure I will discuss the first principle. And these are the five principle risk measure and how do they work. First, we will gonna define what is risk measure. Risk measure is statistically measure that are historical predictors of investment risk and volatility. What is volatility? Volatility is the tendency of change and predictably, and they are also major component in modern portfolio theory or MPT. MPT is a standard financial and academic methodology for assessing the performance of a stock or stock funds as compared to its benchmark index. Types of risk measure. There are five principles risk measures, and each measure provides unique ways to assess the risk present in investment that are under consideration. The five measures include alpha or Jensen measure, beta, R squared, standard deviation, and the Sharpe ratio. Risk measure can be used individually or together. To perform a risk assessment, when comparing two potential investments, it is wise to compare similar ones to determine which investment hold the most risk. So, to determine who is the most risk, hold the most risk of investment is they are basing of what investment is higher percentage of risk. That is the riskier investment. The higher percentage, the more riskier. The low percentage, the lower risk. So we're gonna discussing about the Jensen measure or alpha measure and how it is calculated. The Jensen or alpha is a risk adjusted performance measure that represent the average return on a portfolio or investment above or below that predicted by the capital asset pricing model or CAPM. Given the portfolio or investment beta and the average market return, this metric is also commonly referred to the simply alpha. Understanding Jensen measure is to accurately analyze the performance of an investment manager and investor. Most look not only the overall return of portfolio but also the rest of that portfolio to see if the investment return compensate to the rest it takes. For example, if two mutual funds both have a 12% return, a rational investor should prefer the less risky fund. Jensen measure is one of the ways to determine if a portfolio is earning the proper return for its level of risk. If the value is positive, then the portfolio is earning excess return. In other words, a positive value for Jensen Alpha means a fund's manager has beat the market with their stock picking skills. The real world of example of Jensen measure, assuming the CAPM is correct. Jensen alpha is calculated using the following four variables. Using the variables, the formula for Jensen alpha is alpha equals Ri minus open parenthesis Rf plus B times close parenthesis Rm minus Rf close parenthesis and close parenthesis, where Ri determine the realized return of the portfolio investment, while the RM the realized return of the appropriate market index. The RF is the risk-free rate return for the time period. The B is the beta of the portfolio of investment respect to the chosen market index. For example, assume a mutual funds realized a return of 15% last year. The appropriate market index this fund return is 12%, which is that is RM, and the beta of the funds versus the same index is 1.2, so that is our B, and the risk-free rate is 3, that is our RF. Then the fund's alpha is calculated as alpha equals 15% minus close open parenthesis 3% plus 1.2 times open parenthesis 12% minus 3% close parenthesis. It is equals, we gonna copy the 15%, which is that is I, our realized return of the portfolio investment, and we're gonna subtract the 12% and the 3% inside the parenthesis first, and after that we're gonna multiply the beta or 1.2 to the result of the 12% minus 3%, that is equal to 9, and we're gonna multiply that and 1.2, it is 9 times 1.2, it is equal to 10.8. After that we add the 3% and 10.8, the sum is 3%, 13.8%. After we add the numbers inside the parentheses, we're gonna subtract it into the 15%, and the return is 1.2%. The 1.2 is given a beta. The mutual fund is expected to be riskier than the index, and those earn more. A positive alpha in this example show the mutual funds manager earn more than enough return to compensate it for the risk they took over the course of the year. If the mutual fund only returned 13%, the calculated alpha would be a negative 0.8%. With a negative alpha, the mutual fund manager would not have earned enough return given the amount of risk they were taking. The special consideration critic of Jensen measure generally believes in the efficient market hypothesis, or EMH, invented by Eugene Fama, argue that any portfolio manager excess return derived from luck or random chance rather than skills. because the market has already priced in all available information. It is said to be efficient and accurately price. The theory says precluding any active manager from bringing anything new to the table. Further supporting the theory is the fact that many active manager fails to beat the market anymore anymore than those that invested their client money in passive index fund. So as we gonna is if we gonna invested our monies, we gonna choose wisely or we gonna put a standard to our self is we gonna invested a small amount of money. It is has a low risk. If we gonna invest our money in a bulk way, we had a higher risk. That's why we gonna think wisely when we are investing our money into the right stocks to have a successful investment in the future, and we can build a wealth if we are aware and has a risk management to our investment.
So, hi, I'm here to tell you what is beta. Beta is a measure of volatility risk for an individual stock. It tells you how correlated the stock is with the market average, and it gives you a better idea of how volatile the stock will be when compared to the market. Stock with a higher beta means they are more volatile, so it means that they are more risky than the lower beta means that they are more or less risk or volatile. So how does the beta work? Remember, beta is a measure of how much the stock moves related to the index. It can be thought of a scale in which a beta of 1 is the midpoint. So as you can see here, that is the midpoint. So that's an example. So a beta of 1 represents as a perfect correlation with the stock market. That means that whatever the index does over a given a period of time, the stock should have the exact same movement as the index. Now, when you have a beta greater than 1, for example, that means the stock is more sensitive than the index. So if a stock has a beta of 1.5, for example, 1.5, for example, that means for every 1% change in the market, average stock itself will move 1.5%. Likewise, when you have a beta less than 1, the stock is more less sensitive than the index. So if the stock you're interested in has a beta of 0.7, that means for every 1% move in the market, the stock will only change by 0.7%. It's also important to note that this relationship reflects both positive and negative change in the market. So far that the stock had a beta of 1.5 of the market as a day where it loses 1%. You can expect the stock is to also decline, but it will decline by 1.5%.
R squared. Investment movement attribute to the movement in the bid. in a benchmark index. An R-squared value represents the correlation between examined investment and its associated benchmark. For example, an R-squared value of 95 will considered a high value correlation, while R-squared 50 may consider low. The U.S. Treasury will function as a benchmark for fixed income securities, while the S&P 500 index functions as a benchmark for equities.
Hi, I'm Rika Estefane. I will discuss about standard deviation. This is the normal deviation of Lyman's term. Bell curve is a model that describes how probabilities are spread out and help us inform of how likely outcome is. The total area underneath the normal curve is 100%. The middle of the curve is where the mean of the average value is. It follows the left and half and the right half of the area underneath are each 50%. The standard deviation acts as a sort of a measuring stick whereby you can locate important points along the bottom axis of one standard. The mean of the both sides will capture approximately 68% of the total under the curve. In the area under the curve between 1 and 2 deviations away is approximately 14%. Between 2 and 3 is approximately 2%. This is the complete picture of it's important for you to memorize the three along the what is the curve of deviation of 68% to deviation of 95% of the three deviation of 99.7%. Here's an example how to use the standard deviation on some questions. Middle of the company stock has average return of 7%. Standard deviation is 3%. What percent is the time should investor of the middle blue company expect return of 4% or more? Mean or average is 77% and measuring stick standard deviation is 3. Standard deviation away the mean 3%. Therefore, the markings along the axis will 4 and 5 below 1 at seconds is below 10. At the first above is 13 and the second above is 16 and third above is the question asks for 4% or more. So this is when you total the errors above minus the 1 SD and 34 plus and 13.5 plus 13.5 plus can be rounded to be 84%, which is the final answer.
So good day everyone, I am Nilbert Inzon and I'll be explaining to you what is Sharpe ratio in business finance. So the Sharpe ratio, named after Nobel laureate William F. Sharpe, is a popular measure used in finance to understand the return of the investment compared to its risk. So here's how it works. Number 1, return of investment or return of portfolio. This is the average return, expected return of the investment. So number 2, risk-free rate. This is the return of a risk-free investment such as government bond. The difference between the investment return and the risk-free rate is known as the excess return. So number 3, investment risk or standard deviation. This measures the volatility of the investment returns. A higher standard deviation means the returns are more spread out and thus the investment is considered more risky. So the formula for the Sharpe ratio, RP is the return of the portfolio, so then over a standard deviation of the investment return. So in simple terms, the Sharpe ratio tells us how much excess return we are receiving for the extra volatility that we endure for holding a riskier asset. So a higher Sharpe ratio is as better. It means that the investment is earning more return per unit of risk. So that's it. Thank you.
So good day everyone, I'm Michaela Sabal and I'm going to discuss about ways to minimize risk with stocks. So what are ways to minimize risk with stocks? Ways to minimize risk when investing in stocks is to do through research before picking a stock, diversifying one's portfolio, investing alongside one's risk appetite, having a long-term investment horizon, not panicking in terms of volatility, and regularly evaluating your portfolio. And I'm going to discuss this one by one. So let's start with research. The importance of researching is you'll be able to make informed decision about which stocks to buy and sell. Secondly, you'll be able to develop a solid investment strategy that suits your individual goals and needs. So, before buying a stock, learn about the company first, what it does and how it makes money. It's like checking reviews before buying something. Second is diversifying one's portfolio. One way to mitigate risk is to have a diversified portfolio, which means investing in a variety of different assets to spread out risk. Example is think of your money as a different kinds of snacks. If you put all your money into one type of snack and it turns out you don't like it anymore, you're stuck. But if you have a variety, you can enjoy different flavors. It's like in investing, it's like having different stocks. So if one doesn't do well, others might. Third is risk appetite. Consider this as choosing rides at an amusement park. Some people love roller coasters and some prefer the gentle rides. Similarly, in investing, you decide how much risk, ups and downs you're comfortable with. It's about choosing investments that match your thrill level. So next is long-term view. Picture your investment as a long-term project. Think of investing like planting a tree. It takes time, care, and patience. Investing is a bit like that. Instead of expecting immediate results, it's about letting your money grow over time, like watching your tree become a mighty oak. Next is stay calm. Staying calm allows us to decide accordingly. When the stock market goes up and down, panicking won't help. You need to stay focused. Similarly, when the stock market gets bumpy, it's important not to freak out. Keep your cool and chances are things will get better. Lastly is regular checks. Think of your investments like a garden. You plant flowers, but you need to check in now and then to make sure they're growing well. Similarly, regularly look at your investments, make sure they're on track, and adjust them if needed. So that's all for my part, and thank you.
So my topic is what are the risks with stock? There are many sector-specific and even company-specific risks is investing. In this article, however, we talk at same universal risk that almost every stock faces regardless of its business. First, commodity price risk is simply the risk of a swing in commodity prices affecting the business. Companies that sell commodities benefits when price go up but suffer when they drop. Companies that use commodities as input see the opposite effect. Like as commodity price climbs, consumers tend to rein in spending and this affect the whole economy, including the service of the economy also. Second is headline rest. Is a rest that stores and the media will hurt a company business. With the endless torment of news washing over the world, no company is safe from headline risk. Like example, if headline news is attacking about your company to have a feedback or or background. So is one of the big bad news that can lead to a market backlash against a specific company or entire sector. And third is rating rest. Occurs whenever a business is given a number to enter achieve of maintain. Every business has a very important numbers as far as its credit rating goes. Like example is like assessing risk individual in the daily activities or organization of your company. Next is absolence risk. Is a risk that company business is going the way of the dinosaur. Every few business live to 100 and none of them reach that trip age by keeping to the same business process they started with. So the biggest obsolescence risk is that someone can find way to make a similar product as a same cheaper price. So that's obsolescence risk. And next is detection risk is a auditor compliance program. Regulator or other auditory will feel whenever its company management skimming money out of the company. Improperly stated earnings, the market reckoning company will come what the never surfaces. So the damage to the company reputation may be difficult to repair, and it's even possible that company will never recover if the financial fraud was widespread. And next is legislative rest. Refers to the tentative relationship between government and the business. It's about government and the business. It's basically into the rest that government action will construction or corporation and industry, thereby adversely affecting an investment holding in that company or industry. Like in the actual regs can realize the number of ways and suit new regulation or standards, specific taxes, and so on. So it's about taxes of the government if you have that company to them. Then next is inflationary risk and interest rate risk. So these two risks can operate separately or in tandem. So the interest rate risk is this context simply refers to the problem that rising interest rate causes for business that needed financially. So as this costs go up due to interest rate, it's harder for them to stay in the business. If this climb in this rate is occurring in the time of inflation, and raising rate are a common way to fight inflation. Next is a model risk. Risks that assumption underlining economics and business models within company are wrong. When the models get out of the whack, business and depend on those models being right get hard. So it start a domino effect. Like those companies struggling to fill of their businesses and torn in, but the companies depending on them and so on. Like also when you are not going through presentation about your works and they supplied to measuring, so they expected that you give your all the best, but you didn't do it. And the next is the bottom line. There is no such things as risks free stock or business, although every stock faces this universal risk and additional risk specific to their business. The reward of investing can still far outweigh them. So far, as an investor, you should know the best thing you do to know before you buy anything about a company to prevent the bad situation to makes your company bad to other person. So that's it.
What are risk metrics? Risk metrics are mathematical approaches to gauging the possible loss of security or investment portfolio. When evaluating stocks, risk metrics help investors determine the potential downside. So, Risk metrics are ways to measure how much money you can lose if you invest in something. When you buy shares of a company, risk metrics help you figure out how bad it can get if the company does poorly. So, some examples of risk metrics are value at risk, beta, and Sharpe ratio. So, value at risk, this number tells you how much money you could lose in a worst case scenario. For example, if your VAR is 10,000, it means that there is a very low chance that you will lose more than 10,000. So, ang beta tells you how much your investment moves with the market. So, example, if your beta is 1.5, it means that your investment goes up or down 1.5 times more than the market. A high beta means more risk, but also more potential reward. Next, ang Sharpe ratio. So, Sharpe ratio tells you how much return you get for the risk you take. For example, if your Sharpe ratio is 0.5, it means that you get 0.5 units of return for every unit of risk. A higher Sharpe ratio means better performance. The bottom line: trading and investing are difficult. Picking the right stocks or asset can be complex, and it is hard to know the right time to buy a stock and when to sell it. There are many metrics out there that can help make a decision, particularly those assessing risk. Utilizing the above metrics can greatly assist investors in making the right investment choices. So, ang bottom line talks about how to make money by buying and selling things like shares of companies or other things that have value. It says that it is not easy to do this because you have to choose the right things to buy and sell, and you have to know when to do it. It also says that there are some numbers that can help you decide what to do, especially the ones that tell you how risky something is. It says that using these numbers can help you make better choices and make more money. So, ang example ani kay price to earnings ratio. Ang price to earnings ratio tells how much money people are willing to pay for a share of a company compared to how much money the company makes. A low number means that the share is cheap, and a high number means that the share is expensive.
My name is Gerald L. Arsolai, and today let's delve into the crucial realm of risk management and explore two fundamental strategies: risk avoidance and risk reduction. Risk avoidance is akin steering clear of potential pitfalls altogether. It involves refraining from activities that carry inherent risk with an aim of minimizing vulnerabilities. This approach is often implemented through robust policies throughout producers' comprehensive training and leveraging technological solutions. An example of risk avoidance could be an investor choosing not to buy stocks in an oil company amidst a period of significant oil price volatility, assessing and sidestepping associated risk.
Risk reduction. Risk reduction is the fundamental component of effective risk management, aiming to create more stable and secure environment for projects and businesses. This process involves a true identification and assessment of potential risks, followed by the implementation of strategies designed to either decrease the likelihood of this risk occurring or minimize their impacts if they do. In practical terms, risk reduction measures can take various forms. They may include implement safety protocols, incorporating redundancies, diversifying investment, utilizing insurance, and developing contingency plans. The specific strategies employed depend on the nature of the risk identified and the context on which they exist. By active engaging the risk reduction, organization and individuals can better safeguard their interests, improve decision-making processes, and enhance overall resilience. It's a dynamic of ongoing process that requires continuous monitoring and adaptation to ensure that the risk management strategies remain effective. And the face of evolving circumstances, ultimately, risk reduction contributes to the long-term sustainability and success of businesses or projects by minimizing the negative impact of events.
So now, let's go to the pros and cons about risk avoidance. The first one of the pros is minimize exposure. By avoiding certain activities, the organization or individual minimize the exposure to potential threats. Second one is clear-cut decision making. The decision not to engage in specific risky endeavors simplifies decision-making processes. And the cons on risk avoidance is the first one is missed opportunities. Overly conservative risk avoidance may result on missed opportunities for growth and profit. The second one is the cost. Implementing comprehensive risk avoidance measures can be resource intensive. Now let's go to the pros and cons of risk reduction. The pros of risk reduction is, the first one is flexibility. Allows for a continued engagement in a certain risk-prone activities with a more measured and diversified approach. Second one is opportunity retention. Permits the retention of existing investment while activity managing and reducing associated risk. Now, let's talk about the cons of risk reduction. The first one is incomplete protection. Despite efforts to reduce risk, complete protection is rarely achievable and adverse events by still occurs. The second one is complexity. Managing a diversified portfolio or employing various risk reduction strategies can be complex and requires ongoing attention. So, in conclusion, both risk avoidance and risk reduction are vital tools in the risk management toolkit. The key lies in finding the right balance that align with individual or organizational risk tolerance, ultimately ensuring a resilient and well-informed approach to navigate the uncertainties of business landscape. That's all. Thank you.